Welcome back to Alpha Recap. We're coming to you after the close with a tight but eventful day to unpack. As always, if you have questions, you can reach us at stockalpha.ai. Ask away and we'll get to them. Ready to dive?
Absolutely. Big picture to start. Markets closed down today. We saw pullbacks in the Dow, the S&P 500, and the Nasdaq as investors stepped to the sidelines ahead of a pivotal Federal Reserve decision and a heavy slate of big tech earnings.
Right. It felt like a defensive tape. People priced headline risk into positions not because something dramatic happened today, but because a lot was on the calendar. The Fed and concentrated earnings can do that to a tape.
And speaking of concentration, one of the day's bigger takeaways. Only two of the so-called Magnificent Seven beat the S&P 500 during 2025, Nvidia and Alphabet. That's a reminder that index returns can hide a lot of dispersion under the surface.
Exactly. If you just look at the index number, you miss the fact that performance was lopsided. For passive investors, that's a concentration risk. Your portfolio is dominated by the biggest names, whether you meant it to be or not. For active managers, that creates stock selection opportunities inside that group.
Totally. It forces a rethink of blanket megacap bets. You can't just assume the whole cohort will keep outperforming. Two winners out of seven is a message. Be selective.
Let's break down the event-driven volatility thread. Traders pulled back ahead of the Fed and the earnings calendar. That kind of behavior shows when leadership is concentrated, event calendars matter more, because a big move in one or two names can move the index.
Which brings us to options markets as a real-time gauge. The piece we looked at used Tesla as an example, and they explained the straddle nicely. Want me to put that in plain terms?
Please do. I'm always the slow learner here.
A straddle is just buying a put and a call at the same strike and expiry. You're not betting on direction. You're betting the stock will move a lot. The cost of that trade is driven by implied volatility, or IV, which tends to rise before earnings. If IV spikes before the event, straddles get expensive. After the print, IV usually collapses. That's the IV crush. So if the move is smaller than expected, buyers can get burned.
So for short-term traders, it's a pricing and timing game. You want to predict not just the move, but the market's expectation of the move. For long-term holders, it's a signal that a headline risk is coming and you might manage position sizing accordingly.
Exactly. And that ties into what Kevin Mon at Hennion and Walsh said. Don't reflexively cut risk just because headline volatility rose. He suggested re-examining position sizing and explicit volatility exposure instead of panicking.
I like that. It's a nuanced point. Elevated volatility doesn't automatically mean dial everything back to zero. It means be deliberate about how much you run, where your bets are concentrated, and what you do if one big name gap downs.
And speaking of volatility, they talked about VIX and VIVIX. Quick explainer, VIX is the market's expectation of 30-day S&P 500 volatility, essentially the price of short-term fear. VVIX measures the volatility of the VIX. In other words, volatility of volatility.
When VVAX is elevated, it means there is uncertainty about how much VIX itself might jump. Practically, that often translates into faster, deeper intraday moves. So rising VVIX argues for more caution with short volatility strategies.
Yep, that's why the checklist in the piece recommended being conservative around short vol trades and bumping up protection layers when VVX is rising.
Let's move to the bottom-up news. There were several analyst calls and 8K filings that day. Evercore reiterated an underperform on IBM ahead of earnings, signaling skepticism around near-term operating leverage. Jefferies reiterated a hold on PepsiCo, pointing to constrained growth targets. Those aren't market-shaking headlines, but they matter for portfolio income and risk.
And then there were a string of 8K filings. Paychex, Milestone Pharmaceuticals, and Amicus Therapeutics all filed items that investors should track. An 8K can be anything from a material agreement to a Regulation FD disclosure. They're the sort of filings that can change sentiment quickly, especially in small and mid-cap names.
Right. An 8K isn't always dramatic on the surface, but it can be the first public signal of a liability, a new revenue stream, or a disclosure mismatch. The takeaway, don't ignore non-earnings filings. Put them on your Catalyst calendar.
There was also a strategic all-share merger closing between Zinzino and It Works, disclosed in public filings. For owners of the parent company, that's now a near-term integration story to watch, distribution metrics, synergies, and whether consolidation spreads to peers.
Let's talk debate points, because the article laid out a couple of conflicts worth flagging. First, tactical de-risking versus maintaining exposure. Some traders trimmed gross exposure, Others tightened sizing but stayed active, hunting for idiosyncratic opportunities amid dispersion.
And the second was concentration. Is the Magnificent Seven concentration a strength or a vulnerability? One camp says it's efficient capital allocation towards secular winners. The other camp says it raises single stock event risk and weakens passive diversification benefits.
Both views have merit. If you're an active manager with deep research, concentration can be a tailwind. If you're a passive investor, you have to be aware that your exposure is slanted toward the biggest players, and only a couple of them drove returns last year.
The final debate is around options. Hedge versus cost center. Buyers love straddles when they expect big moves. Sellers like selling premium when IV is rich. But buyers risk IV crush and sellers risk outsized moves. Either way, explicit risk controls are non-negotiable.
Let's put some practical actions on the table. The piece gave a strategic checklist. We'll run through it and translate into plain steps for different investors.
First, run concentration stress tests. Quantify how much of your returns are tied to the top 3 to 7 names and simulate 5 to 15% downside moves in those names. That was one of the concrete recommendations.
Second, calendar proof the book. Mark Fed language events and each big tech earnings date. Consider hedges or scalping implied volatility trades before high vol prints.
Third, use options selectively. If you're buying, size for an expected IV crush. If you're selling, hedge your gamma and be ready for outsized moves.
Fourth, watch volatility of volatility. Rising VVX argues for conservatism around short vol strategies and for pricing higher premiums into protection layers.
Fifth, monitor 8Ks and regulation FD items intraday. Those can be the first public signal of material developments that change a thesis.
And sixth, be tactical but don't panic. Elevated headline risk is not the same thing as a regime change. Stick to process, position sizing, conviction checks, and liquidity planning.
Let's make this concrete for different investor types. Long-term growth holders should reassess concentration. If you believe in the secular winners like Nvidia and Alphabet, increase conviction only with disciplined sizing. If you held the whole Magnificent Seven as a block, think about trimming laggards.
Income and conservative portfolios need to watch those analyst calls. An underperform on IBM or a hold on PepsiCo matters for payout sustainability and downside risk ahead of company-specific catalysts.
Short-term traders and event-driven funds should be explicit about IV and the potential for IV crush. Use straddles or strangles if you want direction-agnostic exposure, but size them carefully and manage gamma risk.
Risk managers and allocators should reevaluate position sizing versus absolute exposure. Elevated VVIX and clustered catalysts argue for tighter stop protocols and explicit hedges on concentrated positions.
And activist or event investors should watch 8Ks and M&A closings. The Zinzino It Works. All share close is one of those immediate leads. Integration milestones and distribution will be early signals to track.
All right, quick recap of key takeaways before we sign off. 1. Market leadership is increasingly idiosyncratic. Don't assume uniform outperformance across mega cap groups. 2. Event-driven volatility will keep offering both risk and opportunity. Use the options market signals and price FI into decisions. 3. 8Ks and other non-earnings filings matter. Add them to your catalyst calendar. 4. Rerun concentration stress tests and be deliberate about position sizing.
And 5. Elevated headline risk is not an automatic trigger to panic sell. Be tactical, keep process discipline, and let catalysts drive sizing and hedging decisions rather than headlines alone.
That's a wrap for today. If you have questions about anything we covered, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening.
Thanks, everybody. We'll see you next time on Alpha Recap.